All right, so today what we're going to go through is how you build a 12-month runway for investors. We're going to assume, for the sake of ease, that you're an early stage founder, you're looking to raise money, you're having or want to start having investor conversations, and now it's a question of how do you tell them how much money you really need? And do you even know how much money you really need? This is an exercise in not only doing the exercise, but also getting a lot of the principles into why is it a 12-month raise? What does that mean? Where are we pulling these numbers from? And why does the investor care, in terms of this kind of time frame? So we'll run through all of that and a whole bunch more things. So first, what is runway, right? We have to make sure we're kind of all on the same page here. Fundamentally, runway is how many months left you have. It's you have X amount of cash in the bank, you have X amount of spend per month, and X amount of timeline before that hits zero or negative, right? So keeping the math super simple, if you're spending 10K a month to keep your business alive and you have 10K per month, you have 120,000 in the bank, you have 1 year of runway left, right? Pretty simple. There's more to the formula and how to think about it and the whole investor context, but we want to start very simple and build our way up through the complexities. Really, it's got a twofold exercise. It's actually really helpful internally, and anybody that's in your finance role is really going to pay attention to it in particular because they know, hey, this is how much blood, is left in our body. Like when we run out of this, it's game over. So internally, there's a lot of focus on, again, how much cash is in the bank. Externally, which we're thinking more of the investor side, it's really useful for pitching investors because they want to know, where are you going? And not just how much runway do you have currently, again, using the 120K example, you have a year of runway left. But if you're going to raise investment, how much more runway does that buy, right? What am I buying as far as the investor? And we'll talk more about that. So investors are evaluating a number of things. And again, lists can always be expanded upon and every investor brings their own nuance. But I want to give you the things that you should always be prepared for because more than likely they're going to come up. First is how long will this money last? Meaning you're pitching me, you're trying to build a 12-month runway as an example, and we're going to put 12 months in air quotes for reasons later. But fundamentally, it's if you want to raise 100K from me as an example, how many months extra does that add to your runway? Were you going to run out of business in 6 months, but now it gives you another 12 months beyond that? So now you have 18 months of runway. This is an important consideration because, again, from an analogy standpoint, startups are the man in the desert. Like you're dying. I wish you weren't. Trust me. I wish I could just, plug it in and away you go. But the truth is you need resources, water, which in this case is validation, capital, momentum, and of course, cash to pay the bills because the bills be coming. What traction will this create? Remember, an investor is buying something. They're buying proof. When you think traction, I want you to hear proof. I want you to hear momentum. I want you to hear validation, things that show the business is working. And we'll talk about what these things, look like. And how will this position you for the next round? Meaning, okay, let's just assume for the sake of ease, you're starting your business January, you have 12 months of runway. Well, assuming you're still here, the next January is going to come around, right? So you need to think through, okay, well, if our money only lasts till December and then January, Happy New Year, we're out of business. Like that's a bad outcome if you don't think through the future of your cash. We call it in banking going concern. We keep assuming businesses are going to keep on going, as it were. So in this scenario, it's okay, well, time's going to pass. So we can't just think about what our cash needs are today, but how they evolve in the future. Because 12 months down the road, maybe now you're post product. Maybe now you're post revenue. Maybe your revenue's up 20%. Maybe it's up 100%. Maybe you're still not profitable. Maybe you're incredibly profitable. And under each of those different situations, depending on your specific situation, you could want to make different decisions, how much money to raise, when to raise, who to raise from. These nuances come about, but they only come about if you actually understand how to think about the plan that you're making, right? It's how to plan, not just do we have a plan. Step one, you know me, I love my steps, set milestones. So we're not raising for more time. Like a lot of founders will come to me with like an arbitrary number of, oh, we're raising money for the next year. or we're raising money for the next 2 years, or we're raising $1 million. And when they say $1 million, it's not like they've broken out expenses for it. They're just thinking, I need at least $1 million to make this work, whatever this is. That's not what real investors care about. Like the mature ones that do this a lot and professionally, they really want to understand what the goals are for you over the next 3 months, 6 months, 12 months. If the only goal that's worthwhile for you to hit is 18 months down the road, you need to think better about your goals. You need to kind of subdivide it. That would be, again, using a little weight loss example, that would be a 200-pound person setting their goal at 150 instead of 189. It's like, hey, why don't we lose the first 10 pounds and then we can start thinking about more aggressive goals along the way. And it doesn't mean the 50-pound weight loss goal isn't still valid, isn't still interesting, doesn't unlock all these amazing things. But 10 pounds still means something. So in this scenario, yeah, I want you to get to post-product, post-revenue, $1 million in ARR. But I would love it if you went from 5 customers to 100 customers. I would love it if you went from pre-product to post-product, from pre-patent to post-patent. Like, give me something to sink my teeth into that means something for the business, right? When I give you $500, what you buy, what you do with that 500 should generate more than 500 in value, right? So I'm trying to move you forward as an investor. I want to see the business be worth more money because of my money. And that means you have to accomplish things, right? Again, across various metrics. So we'll talk more about common milestones, but I just want to give you kind of a quick list of things that these should be some of the things that kind of ring around your head when you're thinking through this. Going post product, right? Because up until then, you're pre-product. You can have all the validation in the world, or you can have no validation at all. And of course, you know my stance on that. Get 1,000x the validation you think you need. But going post product is really meaningful, because once you're post product, you can go post revenue with not a single penny spent and go to market. You can go start to make money because you can be your own sales force. That's really powerful. Going post revenue, that's impressive because, okay, you just had the post product thing and now you're making money. Now we can go from will it make money to how much money will it make? And that is a world of difference, as you can imagine. Sometimes it's a specific threshold of revenue. I want to hit 10K in monthly recurring revenue. I want to hit 100K in annual recurring revenue. The numbers are immaterial or don't matter. Again, certain numbers are psychologically better when you go from 5 figures to 6 figures, when you go from 6 figures to 7 figures, 7 to 8. Again, psychology plays a role in anything, but it's more of, oh, this is a goal that can only exist because you're selling, you're making money. Like, yay, you. How do we take this forward? Releasing X feature. Now, this is a key part. A lot of founders will look at releasing a feature like that's the value. No, it'd be like creating a crowbar. But if nobody uses the crowbar, it's useless. It just sits on the shop floor, right? So in this example, if you're going to release a feature, that feature is released and enables customers to do this and makes us money like that. Like, there's a narrative to the feature. It's not just, we've released an AI. It's like, okay, well, what are you going to do with it? Because if you do nothing with it, then it's like, cool tech, bro, but it doesn't actually help you make any money. It doesn't get me excited as an investor, again, unless I'm just the investor that, you know, perks awake when they hear AI. I am not. And then handling X legal. Sometimes legal is pretty expensive. And by sometimes, I mean basically all the time. And I'm not talking about like forming your company, because that's a little bit of the money you have to be willing to put in yourself, again, just for the sake of being taken seriously. But this is more, hey, we have really expensive upcoming legal contracts. We want to expand into Europe. We want to become this type of compliant, and we have to do these legal contracts. We're going to add a gambling thing onto our company, and therefore we have to go get a gambling license, and we have to do all this legal to do da-da-da. Notice it doesn't matter what it is, if it's legal, if it's sales, if it's product, if it's dev, it's all about, does it add value? Does it make your business worth more fundamentally? Investors want to know what progress their capital is buying. And I say this so many times because founders, they get so obsessed into what they care about, they forget that there's another party that has to care, and it's not just the customer. If you need the investor's money, you got to tap into why they care, not just why you care. Second, let's identify our expense buckets. So expense buckets can look a lot of ways. Founders, subdivide things however they like. I try to keep my stuff very simple. So we're going to do a little run through my common expense buckets. And if you've seen any of my other videos, you'll probably see this, you'll probably be very familiar. So first is go to market, which fundamentally is customer acquisition. This is a very, very, very special bucket for the sole fact that go to market in theory is ROI positive. Meaning if I give you $10 in go-to-market, which is sales, it's marketing, it's biz dev, it's everything that gets customers, keeps customers, and turns them into like referral parties as well. If I give you $10, you should be able to give me 15 back, which means I could then hand you another $10 or maybe even 12. And then you turn that 12 that I gave you into 20. Now I give you 15. So in theory, if your go-to-market works, you can always fund go-to-market with go-to-market. Now you'll notice there's some nuances here. One is how quickly do you collect the cash, which we're going to address this more later. If you have really great sales, but it takes you, again, let's just say you can crush sales over the course of a month, but it takes 6 months for you to like get the deal closed and cash in the door. Well, you may be able to make all that money back, but you're not going to be able to make it until the future happens. All this present time, the month 1, 2, 3, 4, 5, 6, you're losing money. It's only in month, 6, 7, you start making money. Therefore, it's like, okay, you're really running into some risks here where even though on paper you are ROI positive if we set the period properly, but you're actually not ROI positive when it comes to day to day. If you're a B2B business, this is something you have to be especially cautious of just because you have contracts and payment terms and there's some random person who's assigned to pay your little invoice. And so it gets missed or annoyed or it gets part of bureaucracy. It's kind of the nature of the beast, right? Now, if you're a consumer business, the nice thing is you can sell stuff pretty quickly, right? If you sell an e-commerce product, you get the money almost immediately, plus or minus your payment processor causing an issue, right? But notice how consumer products, then you can start to churn stuff a lot more efficiently. I know, for example, a founder buddy of mine from way back when, he used to fund his day-to-day go-to-market expenses via credit cards because he knew, oh, well, this credit card has a $50,000 limit. I'll spend 30 in week 1. I'll make, $50K by week 3. I'll pay off the credit card, no interest. So I got basically a 0 interest loan. But he was really good at converting. He really understood his customer life cycle, his cash cycle. So when you have confidence, notice he has free money to build his business. But it only works if you know what you're doing and the situation is right. So no matter what, go-to-market is special because as we look over a long enough time horizon where even if you're a B2B, you're still going to get your cash, it's not about how much money do I want to give go-to-market. It's how much money can I afford to give go-to-market? Because again, we're not just throwing money there for the sake of throwing money there. I'm throwing money there that every single dollar I give them returns more. Now, when you're an early stage business, it might take you a while to actually break even. You might be losing. Like in the scenario, let's imagine it's a consumer product. You might be losing a lot, even if your cash comes immediately. What if you're really inefficient at customer acquisition? And so you make $10, but it costs you $100 to get the customer. It's like every customer you get costs you $90 in loss. You're not profitable, right? But it starts at $90 in cost. Then you get better and it's $80. Then it's $100 in cost. Then it's $90, then it's $80, then it's $50, then it's break even. Now it's really cheap. Now you sell a product for $10 and it only costs you $2 to get the customer. You have a margin of 80%. This is a really good thing, right? And then from there, it becomes how quickly can you cycle the cash? Now, notice I used a year, but if you can cycle in a week, in a month, you can do this really quick. But it's just about the results actually, showing it's worthwhile. Research and development is fundamentally your product, all things product. I bundle strategy, which is thinking about the product, development, which is building the product, and support, which is supporting the product. It all goes into there. And third is required support operations. I always put the little parentheses because it's my system, so I remember it all the time, but I don't expect you guys to. Legal, compliance, finance, HR, operations. Basically everything that's not getting the customer or working on the product itself. So now the exercise becomes, if we think about the goals on the previous slide, and I was to outline what are the relevant goals 3 months from now, 6 months from now, 12 months from now, 18 months from now, 24 months from now. And then I made you go through this and said, hey, what is it going to cost me in each of these buckets to accomplish these goals? As an example, maybe one of your goals is going post-product, which means it's going to cost you $50K in R&D. But maybe that's accomplished in the first 6 months, but maybe you have $100K, which gets you to X, Y, and Z number of customers, but that's over the course of 12 months. And now all of a sudden, if you look at this timeline, you can kind of cross-section it and go, okay, 6 months in, we achieve these goals at this cost. 12 months in, we achieve these goals at this cost. This isn't about being right. This is about developing a plan that makes sense, a plan that can be tweaked, adjusted, that can be molded to be right. It doesn't have to start right. But this is not something where you can have no plan, because that's how you end up going, oh, we are going to raise $1 million. We're going to put a third into product, a third into go to market, and a third into everything else. It's like, oh, so you just have no idea what you're talking about, right? That's what that says to anybody that, again, just knows what they're talking about. It's like, oh, okay, you don't know. You meet somebody else and they go, oh, so for the next 12 months, here are our goals. Here's some of the things we want to accomplish. We have some stuff we're working on 18 months from now, but here's this, and here's our runway. It's like, oh, you want it. You know how to segment, you know how to plan, you value cash. This shows that a founder's taking it seriously by them understanding the relationship between goals and expenses and how to bucket between them. Now, I'm going to go through a whole other presentation at some point, breaking down all of these expenses in excruciating detail. But right now, I just want you to think, if you were to set goals for the next, one goal per quarter, what can you accomplish in the next 30 days, 60 days, 90 days? And if you can't accomplish anything, if no goal seems relevant, you need to aim lower, set smaller goals, right? And then figure out what it costs. And here's the best part, and here's the key thing. The goal isn't to throw money at things, meaning you want to think about things not just from if you had money, but what you can do without money. That's one of the best parts of go to market. Second point on why it's so special is, in theory, it's free. Not just because you give them 10 and they give you 12, but it's free because if you have your legal done and your finances are fine and everything's good on the back end and you have a product that works, you can just go places and sell it. Right? So even if you're not competent in sales or comfortable with sales, there's nothing in this material plane stopping you from becoming good enough to make the first few sales. So in theory, go to market's even free. R&D and RSO are always with a cost because generally speaking, even if you're a full stack dev, you're not going to be building every single piece yourself. You're going to hire out here or there, get this little thing done, or rely on a few people, or you hate UI UX. So you'll gladly do the whole back end, but you hire somebody else to do the front end. These are very real problems. On the other side, it's like, listen, I would love for you to do all your law via ChatGPT, but I also want you to not get sued and your business to exist 6 months from now. So I'd recommend you probably do your legal with a lawyer. That costs money, right? And we have to have an appreciation for these things. The formula. Love me some formulas. So first, revenue. And when you hear revenue, what I want to encourage is you to always think revenue means not cash, because it's not cash, right? Revenue is potential cash. I want you to think, where's the cash component in this? Because yeah, I made $100K in revenue, meaning I signed a contract in January for $100,000. But if you haven't collected that revenue, if you haven't turned that revenue to cash, it's not the same thing. This is exactly how, to use an extreme example, a business has a $100,000 fee due February 1st. The business closes $1 million in contracts January 1st. The contracts are set to pay, meaning they're going to give their first payment June. That business is going out of business, even though they in theory have $1 million on the books. Now, there are ways to subdivide this. Maybe you do factoring, maybe you have this, maybe you have that. Again, there's different ways. Maybe you get little micro loans. Like if you're scrappy, you can kind of do some of these things. But fundamentally, most founders are going to run into the most common issue, which is I've sold a lot on paper, but I have nothing in the bank and the bills are coming. That's why when you read revenue, I want you to read cash. I want you to think cash and know the distinction between the two and make sure you understand it for you, because this is exactly one of those things. When founders pitch investors, they speak to revenue. Oh, we closed $1 million here and we have 500 there and we have this there. But when founders live life internally, they are thinking cash. They're going, we have 50K in the bank and we have $10,000 in expenses per month. We have 5 months left. So this is something where, again, the terms seem similar. They're very often used kind of not interchangeably, but they're used in the same circles without giving a proper appreciation for the difference. I just want to really harp on this because it matters. So revenue minus your expenses, fundamentally you're going to have expenses, plus buffer equals your total capital raise. And I'll add more on each of these. So as we talked about, revenue, it's not certain, because here's the other side. What if those contracts you close in January, they just decide to pull out on it and they don't end up giving you any of the money, or they cancel, or those businesses go out of business? You can never count on revenue fundamentally. Expenses, you can always count on, because you can just sign an agreement with AWS, to use tons of, data, and all of a sudden a bill will hit your credit card, right? That's just the way it goes. This is why I'm always way more focused on expenses when I'm looking at runway, because yes, if over the course of 12 months, we only spend 500,000 and we make 500,000, well, in theory, we're break even. We don't need any money. But again, similar to that marketing conversation, what if to make the 500 grand, we make most of that 500 grand in Q2 and Q3 and Q4? And what if we spend most of the money in Q1 and Q2? Well, now all our expenses are due at the top. All our revenues are coming at the bottom. We need capital, right? And we don't need capital because the business is bad, let's say. We need capital because our expenses and revenues are not aligned yet. This is a common problem when it's early stage businesses, because they're in this constant tussle of, do I have enough product to sell? How are my expenses? How do I think about my cash? How do I think about making sure I'm still growing, but I'm not hurting myself? Like, there's so many layers to building this that what I want you to just think on simply is, cash I would love to count on. Revenues I can always count on. So when I'm looking at my runway, I want to factor in cash if I'm certain of it. But if I'm uncertain or delayed or anything like that, I'm going to heavily discount it, or potentially not even count it at all. Because the cost of having a couple extra 100 grand in the bank that you didn't account for because you made it in revenue, you have extra money. Yay, you might be annoyed. Oh, we raised a little bit too much money, blah, blah, blah. The inverse is you're out of business. So this is one of those like survivorship biases where there aren't people that are still in business to tell you how bad a decision it is to count on your revenue, because they all went out of business. Everybody that either made tons of revenue or focused on expenses, they're still in business. They don't have to say anything because they're just working. Buffer. So this is a little psychological thing and a reality thing. One, founders are always wrong. And there's nothing you can do to change that. Like, you're just wrong. And it's because you can't predict the future, right? You're not clairvoyant. That's just the way it goes. So what does that mean? Well, looking at go-to-market, there's always, I've never, and I've been doing this a while, I've never run into somebody that didn't want to spend more on marketing. I've never run into a founder that didn't want to spend more on dev, because at a minimum, there's a brand new marketing opportunity we didn't think of that we have to take advantage of. How many times have I been told we have to take advantage of it? On the product side, it's, oh, there's this really critical thing that our customers need, and the thing that they need costs us $20K, and also the customers didn't end up using that much. Brilliant. So this is one of those, rather than try and fight a fight of where am I going to pull good dollars and put it into like bad expense. And again, you can't really know, but I know enough to know the patterns. I just go with a blanket, hey, I'm counting on us to be wrong. I'm counting on us to come up with some ideas, some good, some bad, that we're going to want to test. And those ideas are going to cost money. So if we're raising 100 grand and we really think we only need 100 grand, we can't afford hiccups. and we can't afford ideas. And both of those are a problem, because what if your first lawyer messes up your contract? Yes, I would love for it to work perfect the whole time, but that's $5,000 gone. And if that's the only $5,000 you allocated, well, now where are you going to get this? To get the legal done, to make the sale, to get the cash? The whole business starts to domino because of $5,000. You see how silly this is. This is why, okay, you're raising 100K. We should probably raise at least 125K or at least 130K or 50K, because there's always a good reason to have a bit more money for testing things or even just to keep in the bank. Listen, be a dragon, go to sleep on your pot of gold. You'll sleep better. It's just the way it goes. And then your total raise is your capital raise, right? It's your runway, because in combination with how much cash you have, using kind of our example from the beginning, if you have 120,000 in the bank, you have $10,000 of expense per month, you have 12 months of runway, right? It's the way it goes. Now, again, we're just going to keep things normalized. Let's assume you just keep wanting to spend the 10K a month. It will really grow, of course, but let's just assume you want. Well, now you go raise another 120K. Now you've got 24 months of runway, as well as all the goals that are along that way. So when we think through this, you'll notice there isn't a specific timeline written in this formula. And it's because the timeline isn't as relevant as the goals are, and making sure you have enough time to accomplish those goals. And we're going to talk about that. So goals and the cost to accomplish. Cost is time, resources, energy. Again, resources include money, but there's a cost to getting things done always, whether it's making sales calls, building products, doing whatever. And it's important to understand what goals are meaningful. Meaning, if the first meaningful goal you have isn't 12 months away, it's 16 months away, that's probably, again, I would encourage you to think smaller and build goals along the way. But the fact is, I would rather you wait and delay for 16 months and hit something meaningful than you only get, 3/4 of a goal done and it's not good and no one's excited. I'll give you a good example. There's a story that a buddy of mine told me in investment banking where they kind of act very similar to this. A big boss asked one of his juniors to do some analysis on some states. And the junior comes back after an all-nighter, stayed up all night, and showed the boss a report and had 47 states done. And the boss was like, oh, okay, thanks for giving this to me. Where are the other 3 states? And he goes, oh, I just haven't had a chance to finish them. And he goes, oh, so you didn't do what I asked you to. Now you would think that, oh, but he stayed up all night and worked so hard. Nobody cares about that. The boss doesn't care. Your customer doesn't care. The investor doesn't care. They care about, is the result what they were looking for? Is the result better than what they were looking for? It can't not meet the expectation, because whether you're not meeting it by an inch or not meeting it by a mile, you are not meeting it. This is why I try to get away from purely a 12-month runway, and I try to understand what are the goals that make sense for me to actually aim for. There are some raises, as an example, that I've been a part of that they're raising for 6 months because they know that they just need to write a few checks, and at the end of 6 months, they're going to be in a strong position. They're doing like a little $200,000 friends and family round, let's say, and then they're going to turn that friends and family into a $2 million or $1 million seed raise, predicated off of what they're doing in that 6 months. Again, makes sense, but notice there's a very specific plan in mind, and they're not just thinking about today, but the future. Second piece to this is it takes time to ramp up your money spent. Meaning, if I just handed you 200 grand January 1, you're not going to immediately January 2nd start spending efficiently, start converting, start doing this. Legal needs to be reviewed. HR needs to happen, contracts, you're going to get delayed. Investors are going to take like 2 extra months to wire you the money. Like there's 1,000 little things that will happen that will delay this. So the reason I talk about 12 months and I air quotes it because there are goals that make sense along the way, but here's my conservative math of it. Very simple. If we're starting January 1, I want to give myself 2 to 3 months before I know I'm spending at the spend that I want to be spending at. Basically, before I've ramped up my spend to be good. Meaning if I get 200 grand, I'm probably not going to be spending 4 grand a month. Probably going to be spending like 10 grand, 20 grand, 30 grand a month, right? So it's like once my expenses look like that, let's just say that takes 2 or 3 months to kind of get up and running. So if we're building a 12-month runway, and let's just assume for the sake of argument that you're not going to be profitable at the end, because if you're going to be profitable, it's a whole new world, but you're not going to be profitable. Well, that means that, okay, you only have 9 months of results you can deliver. Because remember, the first 3 months, you were just ramping up expense. You weren't like crushing performance. Well, ideally, you can't start raising on December 31st to have money January 1st if you're going to run out. So you probably need to build like a 2 or 3 month window to raise and close. Because remember, you could close them in November and they take 2 months to wire you the money. It'd be like that. Okay, so let's shave 3 months off the back. So now I have 6 months effectively out of 12 months to really make progress before I need to start getting ready to pitch again, to do all this. That's a lot of pressure. Now, mind you, this is an exaggeration of 3 months and 3 months. It's less an exaggeration. It's more of like the average example. But if you're good, you can always shrink it, meaning maybe it only takes you a month and a half to ramp up before it starts meaning something. Maybe it only takes you, a month or 2 months to close investors because you're more efficient. Great. So now you've got 10 months of runway to work with and 10 months of progress to work with, and away you go. But you want to be cautious of this, right? Because you don't know which scenario you're going to run into. So the more prep you can do for expenses and what you want to spend on, the more efficiently you can activate it. And the more prepared you are with investors, the better you can close them and just get back to work. So I mentioned this in that long-winded explanation I just gave, but effectively, you want to really understand what the end of the runway means for you. If you're at a profit, that means something, because then you could just continue to bootstrap or self-finance or do whatever. If you're at a loss, well, where's the rest of the money coming from? Or is this, the end? Runway needs to account for future capital raises. Now, it doesn't mean you have to go build out the next 3 years without a doubt, but the idea is very simple. If we're looking at January to December for the sake of ease, we should at least be thinking through the next January to December, because in theory, we're going to spend as much, if not more, in all of our major buckets, right? Maybe you're not, because for most startups, right, we're not starting with $1 million full product build and then shifting to $100,000, a year in maintenance. Normally it's $100,000 product build and then another $200,000 and then another $300,000, and as they build and, ramp up their IP value. So if that is the path that we're taking, then we should at least assume that expenses are growing by, and this is where a lot of my job and my work comes in, thinking through all the expenses and the growth and the metrics. But you can also just start from a very simple basis. It's at least going to get 20, 50, 100% bigger. So if that's true, where's that money coming from? And the question then, or the framework then becomes, hey, Mr. Miss Investor, I'm raising, $200,000 for this year. Towards the end of this year, this will put us in a great position to raise our next round, where we estimate we're going to have to raise at least around $750,000 to $1 million. That'll put us in a position to be in the market doing X, Y, and Z. We feel really good about this round. Here are our goals. Here's how we're breaking things down. And here's what we're planning to do for the following round. Like, again, this is one of those where if we're thinking of explaining 2 rounds, 80% plus is on round 1, because it's all about what are we doing here in the now or the next 12 months. The little bit at the end, it's one of those, notice it's not a majority. It's very small, but it is necessary, because if you're only talking about the present, I worry about your future. And if you're a founder that only talks about the future, I worry about the present. It all has to kind of connect. This is the mindset / kind of energy that I try to bring to the founder table, and what I try to encourage my clients to do, because nobody likes a founder with a hard head, especially investors. Like, you can be very strong and very unrelenting as a founder, but unrelenting doesn't mean that you won't listen. It means you won't give up, right? And what that means to me, and what I've seen work, is if I could send any message to the average investor, right, if I'm pitching them, it's, I'm an experienced founder, experienced in my space, experienced with my customer, experienced in whatever way you can say. I have a clear plan of what I want to do. And I can and will update that plan in accordance with how things progress. This does not mean that every 2 weeks you're going to be dynamically changing the website. But what it means is if you're planning a $500,000 budget into marketing, and let's just plan like the worst case scenario. Let's say you spend 100K and you don't make any money. Well, in theory, you're probably not just going to keep throwing the other 400 grand into the fire, right? You might reassess. You might go, hey, within our go-to-market bucket, we spent 100K in marketing. We didn't spend anything in business development. And in Q1, we got no sales. I think we need to shift this around. Let's start with a smaller budget. Let's move it into business development. Let's test that. Oh, that's working well. Hey, we're getting tons of sales. Hey, I want to ramp this budget up. I want to go from originally it was 100K in marketing, then it became 25K in biz dev. Now I want to do 200K in biz dev. It's like, but notice you had a plan you were executing on that you built up, but the results showed that your plan needed to evolve and your willingness to test things and flex a little bit, right? You want to stay in the pocket, but you don't, but you have a little give, right? Where you can kind of go left and right. What is the output? Now, I try not to be overly specific. Like if you're building a financial model and doing these types of things, you can build it in Excel. You can also put this on a slideshow. You can write this on a paper and then present it to somebody. Like it doesn't really matter. It matters, obviously, if you're pitching. VCs don't want to see your handwritten note, but your buddy might, right? It's all about who you're pitching and how you want to pitch them. But fundamentally, these are the things that if I talk to you about a runway, I really want to hear at least this, if not more. One, I want a list of your specific, measurable, and time-bound goals. This doesn't mean you're going to hit all these goals in accordance with every single thing that you laid out, but it means that the goals exist and it's not just arbitrary. This is largely going to be driven by KPIs and accomplishments. KPIs are, grow our revenue 20%, hit 100K in MRR, whatever. Accomplishments are pre-product to post-product, pre-revenue to post-revenue, onboard a CTO, release this major product feature. Things that they're not, like the number would be one, like we onboarded one CTO, but that's not the point. It's not like a unit. It's an accomplishment. Like, hey, we brought on a CTO and that CTO enables this. There we go. Second, so now I've got the goals. I've got the revenue side. I've got the thing that I want out there. Second piece, I need to know the cost to achieve these goals broken down by bucket. I do not want to hear and I do not want to see in your write-ups, oh, we need 100K to go post product and make revenue. And then underneath it, it just says 100K. It's like, no, I need to know what's going into product, what's going into marketing, what's going into sales, what's going into your legal. And if you can't provide that to me, don't be surprised when I, as the investor in the scenario, can't invest in you, right? You're asking for money. This isn't monopoly money. I'm going to need you to put in some work to earn it, right? And mind you, this isn't like 100 hours of work. This is sitting down and thinking and planning based off of a lot of the things you probably already know. And last but not least, a clear understanding of cash position pre, during, and post the runway. This is important not just because of runway, like math, but also from negotiation perspective. Here's the example. If you have 120,000 in the bank and you only spend $1,000 a month and you're raising money because you want to make some investments that cost 200K, well, as long as the business isn't failing and you've got that much runway, meaning you're not like burning cash, you're in a really strong negotiating position, right? You have a lot of leverage because you can walk away. You can just walk away. And investors know that. And then, of course, they know that even if it doesn't put them on the back foot, it at least puts you on more even ground for the sake of negotiating. Same scenario, but now let's imagine you only had 3 months of runway left, 2 months, 60 days, right? A quarter, 2 quarters. You get nervous. Now, this is one of those, you got to learn how to be an actor a bit. You have to be desperate and not look desperate, because if you're about to run out of money, you are desperate. But if you give off desperate energy, it's like being desperate for a date. You will not get one, I assure you, right? You have to not be apathetic, but you have to be not as hyper dependent. It can't be, if I need your money, investor, you and only you. It's like, they don't care about that. They want to hear, hey, this train is moving and it's about to pick up speed and I might not be allowed on board. I need to put in money now. I want to be a part of it. I see what they're doing now and I see where that train is going. Give me a ticket, right? That's what we're selling. And that's, again, the way that we want to understand ourselves. And here's the deal. You can't always change the position that you're in. Some people just have more money than others. Some teams are more efficient. There's a whole way, to think about it. But fundamentally, it's about understanding, if you're going to go into a battle, I want to know which heel is my Achilles heel. You know what I mean? I want to know where I'm weak, because you're going to be a part of that, right? And it could be that you have to do a worse investment deal because your investor's, a bit of a bad guy and wants to put the thumb on you and be like, well, you're going to run out of money, aren't you? Maybe you shouldn't take their money. Maybe you need to take their money. Now, there are certain deals that I would say more founders think they need to take deals, and they actually don't. And a lot of them, live to regret it because they have this horrible investor they're bringing around. So that's why I really try to encourage you to think through all these things, because as an easy example, I've worked with founders that the $1 million goal would have required them to take on a bunch of investors they didn't really want. Like, they weren't VC type people, or the really rich guy that wanted to invest was kind of a bastard. So it's like, eh. The other side, these same people, we scale their goals down to 200K. Hey, well, I can get that from a few friends and family, and I have an investment banker buddy, and my other buddy's a lawyer, and these are people I want to bring on, and then I can get momentum, and then maybe I don't need that investor in the future. We've changed a situation, because even though you're weaker, you could put yourself in a place where the people you're negotiating with, aren't as hostile, as an example. So hopefully this helps. Hopefully this gives you a good framework for thinking through how to build a runway, how to think through runway, how to apply it, and how to kind of make it your own and make it add value to you and your business. So hopefully this was helpful, and we'll see you in the next videos.